Good evening. I am Cam Calderon. Let's get a beer and discuss US payrolls. Today is a very important day in economics, as interest rates might increase by 50 basis points instead of 25. This is actually good for my TLT, but not so good for the rest of the market, I believe. The market took quite a hit after the US payrolls report dropped weaker than expected data. Everyone's talking about it. And it's left many wondering what's the Fed next move will be on interest rate. Over in Europe, the slowdown continues, adding fuel to the volatility fire. Let's dive into the US. The payroll report showed 142,000 jobs in August, which is a bit lower than the 160K expected. The unemployment rate ticked down to 4.2%. Recession flags are there, but it's really that bad. Construction jobs were 24K and leisure and hospitality 46K, which doesn't really mean a recession. So, why all the panic? The Standard & Poor's 500 tanked 1.7% and Nasdaq dropped a step 2.6%, marking the worst weekly decline in months. Meanwhile, Treasuries rallied yields on 2-year fell to 3.68 and the 10-year ticked down to 3.7%. This shift reflects a move to safer assets as everyone is bracing for rate cuts. Future markets are already pricing in 4 quarter points cuts by year end. But here is where it gets interesting. Top Fed officials Christopher Waller and John Williams hinted that a 50 basis points cut is still on the table. Now, I am questioning if the Fed is really going to lean that hard on data. GDP growth is sitting at 3%, which is well above the CBO's estimate of 1.7% potential. That's a sign of an overheated economy, even with all the talk about inflation cooling down. Yes, some think we are on track for a soft landing, but I believe conditions aren't quite right for big cuts. A 25 basis points cut? Sure, that seems more in line with the numbers we are seeing. Anything bigger feels like it will add more volatility to the mix. Do we really want that? Anyway, the 50 basis points actually, the possibilities increase to 60% actually after the readings today on payrolls. Globally, the picture isn't much brighter. European stocks were rocked by the US news, and the stock Europe 600 dropped 1.1%. The FTSE 100 in London fell 0.7%. Germany's DAX had even a rougher day. Germany, I think as well, the readings, the fundamentals for Germany didn't come very good today. And the Japan's topics fell 0.9%, and China CSI 300 slipped 0.8%. So it's safe to say the pessimism is spreading across the board, even internationally, which is worrying. So recession might come actually not from the US but from abroad. Okay, back to the dollar. Initially, it slipped after the payrolls data, but managed to recover by rising 0.2%. The yen, on the other hand, hit 142.4, which is the highest level since January. So there's some definite movement in the currency markets as well. Oil prices have been firming up, although there's still on track for a weekly loss. Meanwhile, gold remains steady near 1 week hikes, reflecting that risk off sentiment is not there, as I mentioned earlier. What does it mean? I think we are in a period of cautious market moves. It's clear that the Fed will rely heavily on economic data, to guide its next steps. But with GDP so strong, I don't see a huge rate cut coming anytime soon. I might be wrong, but I don't believe so. The chatter in the market says the opposite. 50 basic points might be on the carpet. The European Central Bank, however, might have some room for lower rates, given that wage growth in the Eurozone is easing. We'll have to see how it will play, but for now, I bet on the Fed sticking with 25 basic points cuts, gradually steering up toward that elusive soft landing. Okay, let me know your thoughts in the comments. Is the market overreacting or are we heading towards something more serious? Here are other topics that caught my attention in the past 24 hours. Broadcom's warning about AI alone not being enough to drive growth is one of the topics. China's 100 billion short against the dollar is enriching hedge funds through foreign exchange rate swaps. Another news is China's trade surplus gaps since 2022 are raising questions. What would you like to hear more about? Let me know in the comments. Cheers and happy trading.